Booyah! Welcome to the exhilarating world of the stock market. This is where fortunes are made and lost in the blink of an eye. It's a place of high stakes where every decision counts and the thrill of the chase is ever present. It's a wild ride, full of twists and turns. The market can be unpredictable, with prices soaring one moment and plummeting the next. But that's what makes it so exciting. But don't worry, we're here to break it down for you. We'll guide you through the chaos and help you understand the basics so you can navigate this world with confidence. Whether you're a complete newbie or just need a refresher, this guide is for you. We'll cover everything from the basic concepts to the more advanced strategies, ensuring you have a solid foundation to build on. This 10-minute guide will give you the basics. In just a short amount of time, you'll gain the knowledge you need to start your journey in the stock market. Get ready to learn how to potentially grow your money. Investing in the stock market can be a powerful way to build wealth over time. Investing in the stock market can be intimidating. The sheer volume of information and the fast pace can be overwhelming. It seems like everyone is speaking a different language. Terms like bull market, bear market, dividends, and capital gains can sound like jargon to the uninitiated. But trust me, once you understand the fundamentals, it's not that complicated. We'll break down these terms and concepts in a way that's easy to understand. We're going to demystify the jargon and equip you with the knowledge to navigate this exciting world. You'll learn how to read stock charts, understand market trends, and make informed decisions. Think of the stock market as a giant auction house. It's a place where buyers and sellers come together to trade shares of companies. People from all over the world are buying and selling pieces of companies. These transactions happen every second of every day, creating a dynamic and ever-changing market. These pieces are called stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. It's like a real-life game of Monopoly, but instead of Boardwalk, you could own a piece of Apple or Amazon. Imagine being a part owner of some of the biggest companies in the world. You could own a piece of Apple or Amazon. These companies are leaders in their industries, and owning their stock means you share in their success. So, are you ready to dive in? Let's make some money. With the right knowledge and strategy, you can navigate the stock market and potentially grow your wealth. Let's get started on this exciting journey together. Let's talk about stocks. What are they exactly? Imagine your favorite company, the one that makes your must-have gadgets or serves your go-to coffee. When you buy stock in that company, you're essentially buying a tiny piece of ownership. You become a shareholder. Now, why would you want to own a piece of a company? Well, when the company does well, its value increases. And guess what? The value of your stock increases too. That means you could sell your stock for a profit. It's like planting a seed that grows into a money tree. But hold on, there's always a flip side. Just like any investment, the stock market has risks. If the company doesn't perform well, the value of your stock could decrease. That's why it's crucial to do your research and invest wisely. Remember, knowledge is power. Now let's step onto the trading floor, albeit virtually. This is where the buying and selling frenzy happens. Think of it as a giant online marketplace. Two major players are the New York Stock Exchange, NYSE, and the NASDAQ. Here's the deal. When you want to buy a stock, you place a bid, which is the price you're willing to pay. Sellers, on the other hand, set an asking price, or ask. The difference between the bid and the ask is called the spread. The stock price you see constantly changing, that's the last traded price, the price at which a buyer and seller agreed. It's like a dance between supply and demand. When there are more buyers than sellers, the price goes up. More sellers than buyers, the price goes down. Alright folks, time for a quick vocabulary lesson. Whether you're a seasoned investor or just starting out, understanding the language of the stock market is crucial. Let's dive into some key terms that will help you sound like a Wall Street pro in no time. To sound like a Wall Street pro, you need to master some key terms. These terms are the building blocks of financial literacy and will give you the confidence to navigate the market with ease. So, let's get started. Don't worry, it's not as scary as it sounds. With a little bit of practice and some real-world examples, you'll be speaking the language of finance fluently. Let's break it down step by step. Bull market. This is when the market is on fire, with stock prices rising steadily. Investors are optimistic, and the overall sentiment is positive. It's a great time to invest if you believe the trend will continue. Think of a bull charging ahead with its horns. The energy and momentum are all about moving forward and upward. This term symbolizes growth and confidence in the market. Bear market. This is the opposite of a bull market. In a bear market, stock prices are falling, and the overall sentiment is negative. Investors are cautious, and many may be selling off their stocks to avoid further losses. Stock prices are falling, and investors are feeling bearish like a grumpy bear. The market is retreating, and there's a sense of caution and fear. It's a time when many investors might look for safer investments. Dividends. Some companies share their profits with shareholders through dividends. This is a way for companies to reward their investors and share the success of the business. It's like getting a bonus check for owning their stock. Sweet. Dividends can be a great source of passive income, especially if you hold shares in a company that consistently performs well. Market cap. This refers to the total value of a company's outstanding shares. It's calculated by multiplying the current stock price by the total number of outstanding shares. Think of it as a measure of the company's size. A larger market cap generally indicates a more established and stable company, while a smaller market cap might suggest a newer or more volatile business. P/E ratio. This ratio compares a company's stock price to its earnings per share. It's a key indicator used by investors to gauge the value of a stock. It helps investors determine if a stock is fairly valued. A high P/E ratio might indicate that a stock is overvalued, while a low P/E ratio could suggest it's undervalued. Understanding this ratio can help you make more informed investment decisions. There you have it. These are just a few of the essential terms you'll need to know to navigate the stock market confidently. Keep learning, stay curious, and soon you'll be talking the talk like a true financial expert. Happy investing. Now let's talk strategy. When it comes to investing, having a well-thought-out strategy is crucial. It's not just about picking the right stocks or timing the market perfectly, it's about having a plan that aligns with your financial goals and risk tolerance. How do you actually invest in the stock market? This is a question that many new investors grapple with. The stock market can seem like a daunting place, filled with complex charts and fluctuating numbers. But at its core, investing in the stock market is about buying shares of companies you believe in and holding on to them as they grow. There are two main approaches: long-term investing and trading. Each has its own set of strategies, risks, and rewards. Understanding the differences between these approaches can help you decide which one aligns best with your financial goals. Long-term investing is like planting a tree and watching it grow over time. Just as a tree needs time to grow and flourish, so does your investment. This approach requires patience and a long-term perspective. You buy stocks in solid companies and hold on to them for years, sometimes even decades. The idea is to benefit from the company's growth and the compounding of returns over time, riding out the market's ups and downs. The stock market is inherently volatile, with prices fluctuating daily. However, long-term investors are less concerned with these short-term movements and more focused on the overall growth trajectory. This strategy focuses on long-term growth and is less risky than short-term trading. By holding onto your investments for a longer period, you can potentially reduce the impact of market volatility and benefit from the overall upward trend of the market. Trading, on the other hand, is more like a fast-paced game. It involves buying and selling stocks frequently, often within the same day, to capitalize on short-term price movements. Traders buy and sell stocks frequently, sometimes holding onto a stock for just a few minutes or hours. The goal is to make quick profits from small price changes, aiming to profit from short-term price fluctuations. This approach requires a deep understanding of market trends, technical analysis, and a high tolerance for risk. This approach requires more time, knowledge, and risk tolerance. Traders need to be constantly monitoring the market and making quick decisions, which can be stressful and time-consuming. One popular long-term investing strategy is dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the stock price. This involves investing a fixed amount of money at regular intervals, such as monthly or quarterly. By doing this, you buy more shares when prices are low and fewer shares when prices are high, regardless of the stock price. This strategy helps to mitigate the risk of investing a large amount of money at the wrong time. It helps to average out the cost of your investment over time, ensuring that you don't overpay for your investments, and reduces the impact of market volatility. By spreading your investments over time, you can smooth out the highs and lows of the market, leading to a more stable investment journey. The stock market can be tempting, especially when you see others making quick profits, but don't fall for these common mistakes. Panic selling. When the market takes a dip, it's natural to feel anxious. But don't panic and sell your stocks at a loss. Remember, long-term investing is about weathering the storms, chasing hot tips. Beware of guaranteed tips or get-rich-quick schemes. There's no such thing as a sure thing in the stock market. Do your own research and invest based on sound fundamentals. Overtrading. Trading too frequently can lead to high transaction costs and emotional decision-making. Remember, slow and steady wins the race. Ignoring your risk tolerance. Don't invest in something you don't understand or that makes you uncomfortable. Assess your risk tolerance and invest accordingly. Congratulations! You've completed the crash course in stock market basics. You're now equipped with the essential knowledge to start your investing journey. Remember, investing in the stock market is a marathon, not a sprint. Patience is key. Start small, do your research, and don't be afraid to ask for help from a financial advisor. Now tell me, what are your investment goals and aspirations? Are you in it for the long haul, or are you a thrill-seeking trader? Share your thoughts in the comments below, and don't forget to subscribe for more investing tips and tricks. We'll help you navigate the exciting world of stocks and build a brighter financial future.